Hi there, welcome back to my channel Training Express. Today is session number 14. Before we talk about today's session, let's have a look at the answer of last session's question. Question was, as per accounting cycle discussion so far, what is the step number for preparing financial statements? Answer is step number 8. Okay, welcome back. Today is session number 14, and today we are going to complete the accounting cycle. Today we are going to look at the last step of the accounting cycle, closing or closing the books of accounts. Today you will see how at the end of the year we prepare financial statements and then we close our books of accounts so that our accounting books are ready for the next year. Let's have a look at today's session number 14. Today we are going to look at our last step in the accounting cycle, which is closing the books. So let's have a look at today's session. Before we start today's session, it's better to first have a look at what type of accounts we use in our financial statements. For the purpose of closing the books, we can categorize accounts into temporary accounts and permanent accounts. Temporary accounts are those accounts which are used for a specific time period, which is normally a year, and then their ending balance is made zero at the end of an accounting period, which is normally a year. These temporary accounts are also called nominal accounts. The second category of accounts is permanent accounts. Permanent accounts are those accounts which are not used for a specific time period. Rather, their ending account balance is carried forward from one accounting period to another. So that is why they are termed as permanent accounts. Permanent accounts are also called real accounts. Now let's look at the detail of these accounts. Look at the left side and you would see temporary or nominal accounts. We can classify revenue, expenses, and withdrawals as temporary accounts because at the end of an accounting period, these accounts will be closed. In other words, their ending balance will be made zero. On the right side, you would see we have got permanent accounts or real accounts. And you can see assets, liability, equity, or capital. They are called permanent accounts. Now, if you would see the balance sheet accounts, assets, liabilities, and equity, they are termed as permanent accounts. Now, let's see what is closing. Closing means that we close temporary accounts at the end of an accounting period. Here, close means that the ending balance of these temporary accounts will be made zero by transferring their balance into a permanent account, that is, capital. Look at this picture over here. Temporary accounts balance at the end of an accounting period is transferred into a permanent account, which is called capital or equity. Now, for the sake of closing the books, we use a temporary account which is called income summary. Remember, this temporary account income summary is used only for closing purposes. And ultimately, the balance sitting in this income summary account is transferred to the permanent account, which is capital. So you can say that income summary account is acting as an intermediary account between our temporary accounts and permanent accounts for the purpose of closing the books. If you look at the first row, you will see that revenue will be transferred to income summary. In other words, the ending balance of revenue will be transferred to income summary account. Ending balance of all the expenses will be transferred to income summary. And now income summary account will have got certain balance. Now this income summary ending balance will be transferred into capital account. And at the end, we will close withdrawals account by transferring the ending balance into the capital account as well. Now let's see how the closing process works. Look at the first column, temporary accounts. The accounts which we are going to close is revenue, expenses, and withdrawals. Before closing, which means normally, normal balance for revenue is a credit and normal balance for expenses and withdrawals is debit. Now because we are trying to make their ending balance zero, so in order to do that, what we will do, we will just transfer their balance on the opposite side, and this way their balance will be zero. So for example, normal balance for revenue is a credit balance. So when I would debit the revenue with the same amount, ending balance will become zero. And similarly, normal balance for expenses and withdrawals is debit. And when I want to make their ending balance zero, I would put the same balances on the credit side, and this way ending balance for these accounts will become zero. So ultimately, if you look at the last column after closing, as a result of performing these steps, ending balance of our temporary accounts, revenue, expenses, and withdrawals, that will become zero. For the sake of closing, let's look at this example. Let's assume ABC company has got its adjusted or final trial balance on December 31. You can see various accounts appearing here: cash, accounts receivable, computer, furniture and fixtures. These are all asset accounts and they are permanent accounts. Then we have got accounts payable, which is a liability account. This is also a permanent account. Then we have got two equity accounts, owner's capital and owner's withdrawals. Now one of these accounts, owner's capital, is a permanent account, while owner's withdrawals is a temporary account. Permanent accounts are those accounts whose balances will be carried forward from one accounting period to another. And temporary accounts are those accounts whose ending balances will be made zero at the end of an accounting period. If you keep moving forward, you will see there are service revenue, salaries, rent, advertising, and supplies expense accounts. So out of all of these accounts, we will be closing only temporary accounts, and they are withdrawals, service revenue, salaries, rent, advertising, and supplies expense accounts. Now let's look at the closing journal entries. First of all, we will close our revenue account. Service revenue will be debited by $95,000 and income summary will be credited by $95,000. Now let's look at the posting, and you can see the two ledger accounts appearing here, service revenue and income summary. Service revenue has got a balance of $95,000 on the credit side, which is normal. And now because we want to make the balance of this account to zero, so we will post this journal entry. So service revenue will be debited by $95,000. And now ending balance here is zero. Similarly, income summary, we are using it first time. So income summary will be credited by $95,000 as well. And if you look at the ending balance of income summary right now, it is $95,000 so far. Let's look at the posting again. Service revenue was debited by $95,000, and in the service revenue account, we debited it by $95,000. And similarly, income summary was credited by $95,000. So in the income summary account, we credited it by $95,000. Second closing entry will be to close each expense account. If you remember, in the trial balance, there were salaries expense, rent expense, advertising expense, and supplies expense account. So we are going to close these accounts now. Normal balance for all of the expenses is debit. So when we are closing them, we will credit them. So this way their account balance will be zero. So let's look at this journal entry. In this case, income summary is debit and salaries expense, rent expense, advertising, and supplies expense is credit by individual amounts. Now look at these various ledgers appearing here. Salaries expense, rent expense, advertising expense, and supplies expense. These expense accounts have got certain debit balances. Because we are going to close these temporary accounts, so we want to make their balances as zero. So what we will do, we will credit each of these accounts by the same amount, and this way we will post the previous journal entry. Salaries expense will be credited by $40,000, and you can see now the salaries expense balance is zero. Rent expense will be credited by $15,000. Ending balance is now zero. Advertising expense will be credited by $10,000. Ending balance is zero. Supplies expense will be credited by $5,000 and ending balance will be zero. And the total of all of these is $70,000, which we debited to income summary. So income summary account will be debited by $70,000. And now so far you can see the ending balance sitting in the income summary account is $25,000. Okay, so this is the time to record our third closing entry. So far we have closed our revenue account and expense accounts. The difference between revenue and expense is either a profit or loss. So in this case, it is a profit of $25,000. So whenever we earn a profit, our capital is increased. And whenever capital is increased, we always credit it. So we will debit income summary by $25,000 and we will credit capital by $25,000. Now this is the time to post. So look at these two T accounts, capital and income summary. Capital account has got an opening balance of $6,500. And now we will post this transaction here. So capital account will be credited by $25,000. And by the end of this transaction, our capital ending balance so far is $31,500. Now look at the income summary account. Income summary account has got a credit of $95,000 from entry number 1, which was service revenue, and a debit of $70,000 from entry number 2, which was expenses. And now we are going to debit income summary account by $25,000. So this way posting is completed. And now you would see that income summary account, which we used only for closing purposes, has got an ending balance of 0, and all of the balance has been transferred to the capital account. Now let's record our last closing entry here. We are trying to close the withdrawals account now. So capital will be debit by $5,000 and withdrawals will be credited by $5,000. Look at the T accounts. Capital account opening balance is $6,500, and then from entry number 3 it got a profit of $25,000 transferred. Now if you look at this journal entry, we are now going to post this journal entry. So capital account will be debited by $5,000. Now look at the other T account over here, withdrawals. Withdrawals has got a debit balance of $5,000, and when we post this transaction, withdrawals will be credited by $5,000. Now you would see that withdrawals account's ending balance is 0. And now we would like to calculate our final ending balance for the capital account, which is $26,500. Let's look at the summary of these closing journal entries. First of all, we closed our revenue account, revenue debit, and income summary credit. Then we closed our expense accounts. Income summary was debit, and salaries expense, rent expense, advertising expense, and supplies expense was credit. Third entry which we did was to transfer the profit or loss to the capital account. In this example, we earned a profit. So income summary debit, capital credit. And the last entry was to close the withdrawals account. Capital debit, withdrawals credit. At the end of closing, ABC Company has prepared a post-closing trial balance. Try to note one thing here, that in this post-closing trial balance, only permanent accounts are appearing. Cash, accounts receivable, computer, furniture and fixtures, accounts payable, and owner's capital. Now next year, ABC Company will start with these balances. Ending balances of this year will become the beginning balances of next year, and then next year ABC Company will start recording its revenue, expense, and withdrawals account balances from 0. Now at the end of this session, Let me ask you a question. Income summary account is a permanent account. True or false? For the answer, please check out my next session. So, this is the end of today's session, session number 14. Let's have a look at what we have learned today. Today we learned that for the sake of closing, we can classify the accounts into the categories of temporary and permanent. Temporary accounts are called nominal accounts and permanent accounts are called real accounts. So the process is that at the end of the year, we close our temporary accounts and whatever the balance, we can transfer it into the permanent accounts. And once we have closed our books, we prepare a post-closing trial balance, which lists only permanent accounts, which means assets, liabilities, and equity. Once we prepare the post-closing trial balance, now our books are ready for the next year to be starting. That's all about today's session. Please stay tuned for more accounting sessions and don't forget to subscribe to my channel. Thanks for watching.